And this, I think, is one of the most important slides, probably one of the most important slides we've written in past 6 months or so. And it explains to you what is the rationale behind what is happening right now, right? So we will look at two indices. One is Nifty 500 and Nifty 50 index. So let's look at Nifty 50 because that is more commonly known. In September 24, when it peaked, now we know in the hindsight, it was at 26,200 or so. Now it is down by 4,000 points or so. And the change is 15% decline. P ratio, which was 24.8, is now close to 20, nearly a 20% decline. ROEs remain more or less steady. Earnings growth, which was 15% then, is now 11%, right? This is EPS growth. If you look at PAT, aggregate PAT growth, the number is much slower at about 7% or so, right? Similarly, for NSE 500, index correction 18, P derating of 20%, RO is more or less similar. But again, you see earnings growth, which was 22%, has come down to 14.5%, a deceleration. Now, the question is that if earnings are going to grow at, and my guess is this number of 14.5 for NSE 500 may go to 10 to 12%. And for Nifty, again, between 10 to 12% or even lower, right? So if this number is going to be 10 to 12% and RO is going to be 15, what is the multiple that market should trade at? So mathematically, I've written it here that if the index trades between 17 to 17.5 times, then it appears more logical that we have hit some sort of an average zone where it takes care of market valuations, which means that we will exit the frothy zone and enter what I call an average zone. And we are more or less very close to there in the large cap universe.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.